when gold goes along with silver, it will be explosive. It will be the fear. When markets go up on fear, it's much more powerful than on greed. Central banks, sovereign wealth funds, and wealthy individuals, family offices, they actually want the physical, and they don't realize how these futures markets are run. And they're saying, well, we want to buy a future and we want delivery. And that's really ruining the paper game. And that's why we continue to see manipulation, arbitrage. People will start, they're draining the physical metal from the exchanges in the West and taking it to China to sell it for profit.
Do you believe that really, realistically, that will be the case going forward? I mean, the governments will probably try to get a hand of a portion of that precious metals from the holders in a way of higher taxation. I'm not talking confiscation.
I don't want to buy gold because they might confiscate it.
Let's talk a bit about gold and silver specifically. Do you see gold entering a speculative phase, or is it just purely reflecting the financial chaos we are in or we are entering?
Yeah, I think it will look like speculative, but what it will be reflecting, I think, is fear. Fear of the currencies, fiat currencies, losing, people losing faith and confidence in fiat currencies. And part of that is to do with how our leaders and central bankers are running things. And you see what's going on now vis-a-vis the US and Iran, this war. All the, yeah, it just, I think people are losing more and more confidence, not just in the US administration, even though there's still a lot of people who think Trump can't do no wrong, can do no wrong. But even in Europe, I think people are losing faith and confidence in the leaders here as well.
Yeah, that's the case.
Yeah, I mean, Europe is like completely shot itself. It's almost like they're doing it on purpose to kill the economies, not just in the EU, but in the UK as well. Like they've shut themselves off from cheap energy from Russia.
This isn't speculation. It's a silent vote of no confidence in global leadership. As Mario Innecco points out here, gold's move isn't driven by greed cycles, but by a steady erosion of trust in fiat systems and policymakers. When energy shocks, geopolitical tension, and policy missteps stack together, markets don't wait for confirmation. They reposition quietly. What's missing is that equity markets often ignore this early warning signal, even as capital rotates defensively. If this trend persists into the next Fed cycle, or geopolitical escalation, portfolios heavily exposed to risk assets could face sudden repricing. Next, Mario Innecco discusses how policy decisions in Europe accelerated this breakdown in confidence.
The Germany is completely, completely destroyed its nuclear energy industry because of what happened at Fukushima.
Yes,
But
that was a big mistake.
yeah, but I heard one country, I think it was Italy, apparently they're going to start
Yes.
looking into nuclear energy again. So maybe they're going to wake up. But I think they've done a lot of damage. And when people lose faith and confidence in the state and the central bank, they lose faith in the currency because these are the people who issue the currency. So that's how I see it.
Yeah, that's correct. And even the politicians acknowledge that they were wrong about the nuclear energy in Germany. Mario, just one question about gold, then we will move on. If gold were truly priced by the free market instead of the paper derivatives, what do you think the real price would actually be?
Yeah, I mean, a lot higher, but I can't really tell you where. But I think it is frustrating, and I've been involved with gold since 2002.
Energy policy mistakes rarely stay isolated. they ripple straight into currency credibility. As Mario Innecco points out here, when governments undermine their own economic foundations, like Germany did post-Fukushima, investors don't just question growth, they question the currency itself. This is where the gold pricing debate becomes critical, because if price discovery is distorted by derivatives, then traditional valuation models break down. Markets may appear stable on the surface, but underlying confidence is eroding, especially as Europe faces structurally higher energy costs since 2022. For investors, that means reassessing exposure to regions with policy instability rather than chasing nominal returns. Next, Mario Innecco unravels what gold might actually look like in a true free market.
And at the time, I worked in the bond markets as a futures and options broker, and I started following gold more closely, and I realized right away that it didn't look natural the way it traded. The same thing happened every day at the same time, which usually doesn't happen in the bond market. So yeah, it is frustrating, but all it means is that when when gold goes along with silver, it will be explosive. It will be the fear, the fear. When markets go up on fear, it's much more powerful than on greed, I think, and that's what we're gonna see. So yeah, it should be a lot higher, of course. Like in China, silver's trading, for example, $10 higher than the paper price. Gold, not so much, but yeah, I think yeah, it should be a lot higher. But the the key is, I think, to be patient because eventually they will have to. Unless they let the price go higher, there will be a complete shortage. And that's what we're seeing, with some of these market closures, is because there is a shortage.
When price action repeats mechanically, it's not a market, it's a system under strain. As Mario Innecco points out here, the unnatural trading patterns in gold suggest structural interference rather than organic supply-demand dynamics. The key signal investors often miss is the divergence between paper and physical markets, like the reported $10 premium in China, which hints at tightening supply beneath the surface. Historically, fear-driven rallies, unlike speculative bubbles, tend to be sharper and less forgiving once they break out. If shortages intensify into 2026, this disconnect could force a violent repricing across metals and related equities. Next, Mario Innecco shows why shortages, not speculation, are driving the next phase.
And the only way to stop the shortage is to allow prices to go higher, because when prices go higher, people who have the physical metal, they might sell some into the market, and it might also encourage people to explore for more of the metal. And even then, it takes time to explore gold, silver, or other metals, and then develop a mine. So yeah, higher prices will eventually come.
That is correct. You mentioned, yeah, Shanghai silver. I believe last week we had a 16% premium at one point. That's huge. What is that telling us? So that tells us that the Western markets are still heavily manipulated, and that, let's call it, Shanghai markets more realistic. They are probably in a way manipulated as well, but can you give my audience some clarification about this?
Yeah, yeah. For example, back in the early 1900s, there was a trader called Jesse Livermore. He's one of the most famous speculators, and he started out when he was younger. He didn't have enough money to have a brokerage account.
A 16% premium isn't a pricing anomaly, it's a warning signal markets are misaligned. As Mario Innecco points out here, when physical markets like Shanghai trade significantly above Western paper prices, it exposes a structural imbalance that can't persist indefinitely. The overlooked reality is that supply responses in mining take years, not quarters, meaning shortages can deepen even as prices lag artificially. This creates a dangerous illusion for investors relying on headline prices while real demand builds underneath. If arbitrage flows accelerate, Western exchanges could face credibility stress sooner than expected. Next, Mario Innecco discusses how historical market structures mirror today's distortions.
So he used what was called a bucket shop. And bucket shops were run by gangsters, criminals, and people who ran betting and horse races. And all you did was bet on the price of the stock. You didn't actually buy the stock. And I think that's how the Western commodity markets have been run, like bucket shops. Yes, they do say that you can take delivery, but usually it was only like 1% of all the trades would, of the open interest, people would want delivery of the physical metal. But now it's changing because central banks, sovereign wealth funds, and very wealthy individuals, family offices, they actually want the physical, and they don't realize how these futures markets are run. And they're saying, well, we want to buy a future and we want delivery. And that's really ruining the paper game. And that's why we continue to see manipulation because they're trying to hold on, but eventually they can't because there's the arbitrage. People will start, they're draining the physical metal from the exchanges in the West and taking it to China to sell it for profit.
What looks like a deep, liquid market may actually be a thinly backed betting system. As Mario Innecco points out here, if historically only around 1% of futures contracts result in physical delivery, then most price discovery is detached from real supply. The shift now is critical. Central banks and large capital pools demanding actual metal expose how fragile that system really is. This isn't just about gold, it's about credibility of Western exchanges as a whole. If delivery demands rise into 2026, forced unwinds could ripple into broader commodity and even equity markets. Next, Mario Innecco unravels why shortages are now emerging from years of artificial pricing.
And even in China, there isn't that much metal left. So all these years of manipulating the prices lower has created a shortage. That's what usually happens when not just markets, but politicians as well, when they put price controls, for example, for rents and other things. People who own houses or apartments to rent, yeah, they stop renting because, putting it up for rent because the price that they're forced to rent it at doesn't pay the bills. So it's the same thing with commodities, and yeah, and I think we're very near the end game of these paper markets, and that's why these exchanges are having problems and glitches. And I think a lot of these exchanges, eventually, you could see them closing for a day or two or a week, and people unable to get the real metal.
Yeah.
You have to pay a lot more, for just from dealers, but not from the exchanges.
Yeah, Mario, you said that gold and silver are out of the system.
Price controls don't stabilize markets. They quietly destroy supply. As Mario Innecco points out here, years of suppressed pricing in metals have led to the same outcomes seen in rent-controlled housing. Producers step back, and shortages build beneath the surface. The overlooked risk is operational. Exchange glitches and temporary closures aren't random. They're early stress signals of a system struggling to meet real demand. Investors focused only on spot prices may miss rising premiums in physical markets, which often lead price moves. If access tightens, liquidity assumptions across portfolios could be tested suddenly. Next, Mario Innecco discusses whether gold and silver are effectively moving the financial system.
Do you believe that really, realistically, that will be the case going forward? I mean, the governments will probably try to get a hand of a portion of that precious metals from the holders in a way of higher taxation. I'm not talking confiscation. However, they will try to get a part of that. Do you agree?
Yeah, I mean, it depends on the country, the jurisdiction. Um, and I mean, governments and central banks have a lot of gold, but yes, they could put capital gains tax, like in the Netherlands. They even want to have unrealized capital gains taxes, which is crazy. Here in the UK, if you hold gold and silver coins that are minted in the UK, there's no capital gains tax. But you know that could change. Anything can happen. Governments, when they're desperate, they'll resort to anything. But and people have said that, and for years, you know, they've asked me that, and they said, "Oh, I don't want to buy gold because they might confiscate it." But you know, if you didn't buy gold 10 years ago because of that, you're losing out a lot right now as it is. So I think it's, yeah, there is the risk, but I still think it's good to have some, you know, gold and silver outside the system and try to, yeah, keep it well hidden and find ways to, you know, use that gold and silver without having to, let's say, go back into the monetary system. And by that, I mean privately dealing with other people. So, you know, if someone has something you want, you say, look, I've got an ounce of gold. Do you want to exchange that? And you just do the deal like that.
Yeah, it makes sense.
The real risk isn't confiscation, it's slow, quiet erosion through taxation and policy shifts. As Mario Innecco points out here, governments don't need dramatic moves when tools like unrealized gains taxes can gradually capture wealth without triggering panic. What's often ignored is jurisdiction risk, where rules can change faster than investors can reposition, especially during fiscal stress cycles like post-2020 debt expansions. For long-term holders, the question isn't just what you own, but where and how it's held. Missing a decade of gains over fear can be as costly as policy risk itself. Next, Mario Innecco discusses practical ways to operate outside traditional financial rails.
What would you do? How would you position if you are, let's say, in Europe, you live in Europe, how would you preserve wealth? How would you position your investment strategy going forward? Is it just to invest in precious metals or something else? Tell me more.
Yeah, I mean, I would make sure I would keep some physical gold and silver outside the banking system because, you know, if they come in with this digital euro and there's a crisis, uh, and you only got like old euros, let's say 100,000, and then they say this old euros you can only spend 20,000, then you know you've lost access to all your savings. But if you've got gold and silver outside, they shouldn't really be able to touch it. So I would be doing that in terms of investments. I mean, that's up to people to decide which businesses they think are worthwhile having. But I would probably try to stay away from
Market.
financial businesses like insurances and banks and things like that, and focus more on like consumer staples because people always need to buy things and eat and drink and stuff like that.
Capital controls rarely arrive loudly. They show up disguised as temporary safeguards. As Mario Innecco points out here, the risk of a digital euro system isn't just technological. It's about conditional access to your own money during crises. The overlooked shift is strategic, moving from growth-driven portfolios toward resilience, where sectors like consumer staples outperform during monetary stress cycles. Since 2022, we've already seen financials react sharply to rate shocks, exposing their vulnerability. Investors who ignore access risk, not just price risk, may find themselves constrained when it matters most. Next, Mario Innecco shows how portfolio positioning changes when monetary systems themselves become unstable.
You mentioned Bank of England and central banks. Central banks claim they've learned from the past crisis. From your perspective, have they actually fixed anything or just delayed the inevitable?
I think they've just delayed the inevitable. Central banks, they are, along with the governments that give them the power, without government legislation, there is no central bank because it's a monopoly. So what central banks try to do is management of perception economics. I think it was Jim Sinclair who coined that phrase. It's called a mope.
Yeah.
And basically, they're the ones who inflate because they can create currency out of thin air. But their job is to keep the public, to keep perception of the inflation they create under control to make sure investors are like happy with what they do. So they're always like they use open mouth policy, right? In their meetings, they try to like manage perception of the markets. And I think they're kind of losing the game because since 2022, long-term bond yields, government bond yields have been rising.
Central banks didn't solve the problem, they just rebranded it as stability. As Mario Innecco points out here, management of perception is the real policy tool, where communication often matters more than actual balance sheet discipline. Since 2022, rising bond yields, moving from near zero to 4 to 5%, signal that markets are no longer fully buying that narrative. The gap between inflation creation and public confidence is widening, and that's where risk builds quietly. For investors, this means policy signals may lag reality, especially heading into future rate decisions. Next, Mario Innecco discusses how these pressures tie into the idea of a global monetary reset.
I mean, they rose a lot in 2022, 2023, and they've been under control, but they're still really high compared to like what they were from like 2008 to 2021. They're near zero and one. Now they're more like four or five.
Yeah. Mario, hypothetical question. If I wake up tomorrow and the global monetary reset had begun, what would be, how would the headlines look like? How would that look in the real terms? I mean, the next monetary reset.
Yeah, I think there are two ways it could happen. It could happen gradually. I'm sorry about this. I need to. Can you edit
Yeah,
that?
sure.
I don't know why this is coming up. I need to turn off.
Hmm.
Sorry about that.
No worries, I can edit.
So I think a global monetary reset could ha happen in two fashions. One is just gradually, naturally, allowing the market to take things where they want it to go, like gradually.
Markets rarely reset overnight. They adjust quietly until the shift is undeniable. As Mario Innecco points out here, the idea of a gradual monetary reset aligns with what we've already seen since 2022. Higher yields, tighter liquidity, and slow repricing across assets. The overlooked detail is that normalization from near zero rates to 4 to 5% already represents a massive structural reset, just without the headline shock. Investors expecting a dramatic event may miss the ongoing erosion happening in real time. This slow transition can be more dangerous because it masks risk buildup across portfolios. Next, Mario Innecco unravels the alternative scenario where resets happen suddenly and without warning.
And by that, I mean allow the gold and silver price to keep rising in all currencies. And to some extent, that's happening. Or there is another option that on the weekend, all the major central banks and governments of the West, they announced that they're going to close the market for, let's say, a week. And then after that, we're going to have a new system and all currencies, for example, will be fixed or the price of gold will reset to a certain level and then people can't react and unless you have the gold and silver you get left holding the old currency. They might bring in a new currency, and they might give people a limit of how much they can spend, something like that. I have a feeling they might try to do just the gradual one, what they're doing right now. And what they're doing right now, very few people realize that it's going on. So it's a little bit like, the analogy of the frog in the pot of water. You boil it slowly, and then all of a sudden, they start realizing if they don't jump off, they could die. I think that's what they might do, because if you look back in 1934, when the U.S. Reset the price of gold from $20.67 to 35. Back then, gold was part of the system. The dollar was a fixed weight of gold. Now it's traded freely. So that's why I think that's how I think it might happen.
The biggest risk isn't a shock reset. It's realizing too late that the reset already happened. As Mario Innecco points out here, gradual currency erosion and rising gold prices across currencies may already represent a soft transition to a new system. The historical reference to 1934 highlights how quickly rules can change when governments act decisively, often leaving investors with limited options. Today, the difference is subtlety. Limits, controls, and revaluations can unfold quietly before most react. For portfolios, this means preparing for both slow erosion and sudden policy shifts simultaneously.